Welcome everyone. We're happy to be here today to present to do a presentation on employee stock ownership plans. ESOP, is it a good fit for your company? Really, it's really not a yes or no question based off the information that we're going to share today. But at a minimum, what we want to do is try and equip everyone with information to at least explore further down the road if employee ownership or an ESOP is right for your company or organization, or at least start the conversation at some point. In the marketplace and the economy, employee ownership continues to gain momentum and be talked about as a succession plan, related to broad-based ownership, and then some certain tax advantages. And we're gonna go over that in pretty good detail today. Kind of a 101 session, but should give good information for the group. And feel free to ask questions as you so choose. Just going to introduce myself, Kirk Lindeman with Eide Bailly, consulting and audit partner. I spend about 50% of my time on compliance and 50% doing sell side advisory, transaction analysis for employee-owned companies and transactions. Happy to be here with Bart McAloney, and I'll let him introduce himself.
Good afternoon, everybody. Bart McAloney with Atlas Legal Services. An ESOP attorney. I've been in the space now 16 years. As ESOP counsel, we've had the opportunity to represent companies, trustees in ESOP transactions, as well as individual shareholders. Like Kirk said, we're seeing a lot of interest and activity level in the ESOP space. It's likely a transition option that maybe hasn't been as well documented or marketed out in the space. So there's a lot of, as the ESOPs continue to gain some traction and more people hear about them, we're starting to see a lot of activity in terms of new transactions that are taking place. So appreciate the opportunity here this afternoon to talk about ESOPs. Maybe just getting into it, we talk about ESOPs, so what does that stand for? What's the acronym? The acronym is an employee stock ownership plan. An ESOP, kind of at its core, is a qualified retirement plan. And as such, the federal government provides certain tax benefits to ESOPs as a qualified retirement plan. And because of those tax benefits and because it is a retirement plan, it's subject to both regulation by the Internal Revenue Service through the Internal Revenue Code, and also through ERISA through the Department of Labor. So you've got kind of two federal regulatory bodies that both have jurisdiction over ESOPs and can audit or examine them. As qualified retirement plans, there are really kind of two hallmarks as a retirement plan that the ESOP checks. One of them is you have tax deductible contributions that the employer can make to the plan, and tax deferred growth in terms of the employee accounts that are within the ESOP. Probably what differentiates an ESOP from other qualified retirement plans, and the key feature really, is that the ESOP can actually borrow money to acquire stock in the sponsoring employer. I mean, besides being designed specifically to hold stock in a company, it's the only qualified retirement plan that can actually borrow money to acquire that stock. So it is definitely a hallmark, like I said, a unique creature with even in ERISA itself. One of the questions we get a lot in terms of ESOPs as a qualified retirement plan are, well, how much are the employees having to kick in through like a salary deferral, elective deferral, similar to a 401k? And the answer is, in almost all instances, in most of the transactions we work on, the answer is zero. All of the contributions that we reference in terms of ESOPs are all made by the company and are not being made by the employees. There is an ESOP, a specialized kind of ESOP called the KSOP, where that can take place, but the vast majority of ESOP transactions that you hear about are entirely company funded. So it's a company funded benefit.
Okay, here's just some general industry data that's published by the NCO, a great organization that is very supportive of employee ownership and ESOPs. Just kind of give a lay of the land on where, by region, where these employee-owned companies are. And this includes partial ESOPs or 100% owned ESOPs. But you'll see the large amount of activity, and as we talked about already, they're continuing to gain traction. A lot of the states are starting to adopt certain bills and legislation to promote employee ownership and ESOPs and lessen the burden of some of those upfront costs. And even at the federal level, there's been some minor victories related to ESOPs and the support that continues to be there as well. We get a lot of questions as well on, does my industry fit within, does my industry fit for an ESOP? And as you can see here, just another figure that lists out maybe the more popular ESOPs by industry. And this is, as you can see, there's plenty of different industries there. I think what we would usually say is that some industries probably work better than others, but if there's a dedicated employee base, a good management structure, and the company has profitability, I think any company that has stock can become employee owned or an ESOP.
Yeah, so kind of kicking off that a little bit, maybe to touch on, when we talk to companies that are looking to go ESOP, what are some of the benefits that an ESOP can provide in terms of implementing one for a particular company? And so these four categories are kind of a condensed version of what we think are sort of the key reasons why companies look to implement an ESOP: liquidity, flexibility, favorable tax treatment, maintaining company culture to reward employees. Like any other, a succession plan involving an ESOP is one example of a business succession strategy. And maybe one that you hear about the most are the unique tax advantages, that we'll talk about with regard to an ESOP. Maybe talking about liquidity and flexibility specifically a little bit. ESOP is unique in that you're actually, when you implement an ESOP, you're actually creating a market to sell shares. So by implementing an ESOP, you're creating the buyer essentially that will buy stock in a company. Not focusing on the tax benefits in terms of this, but a sale of stock versus the sale of assets to a third party has a certain amount of tax advantage to it. The other thing that you see is with implementing an ESOP, or what we often see in those cases is, besides the ESOP itself owning shares, we'll see other kinds of, call it synthetic equity, that's put in place for key employees, mostly being stock appreciation rights. Also potential for warrants to be implemented in terms of an ESOP transaction. In terms of flexibility, maybe versus say a third-party sale, an owner does not have to sell all of their stock at one time to an ESOP. They can decide to sell a lesser percentage. There are sometimes some disadvantages in doing that, but if an owner is not ready to sell all of a company at a particular time, they don't have to as part of implementing an ESOP. The other thing that can occur, even if there's 100% sale, is that a lot of times in almost every ESOP transaction, the sale of the shares, there's often seller financing, or almost in every deal there's seller financing that takes place. And so the income tax aspect of that, even though it's that capital gains rates, can generally be spread out over a number of years, which gives the seller some flexibility in terms of their tax planning. A lot of that depends on how much bank financing is incurred in terms of the transaction itself. But again, the process is structured in a way to basically check the boxes of what the owner's goals would be. I guess if there's one thing in this that we see sometimes in other ESOP transactions that we see, because the ESOP is set up as a trust, and it's tax exempt, and it's a unique situation, probably one of the few where you have the opportunity to structure a stock sale to a tax exempt buyer, meaning that there are some planning opportunities either through accelerated deductions in terms of depreciation, potentially tax method changes, and contribution planning with regard to the ESOP, that are really, one-time opportunities that you can take advantage of in selling to an ESOP. And in terms of structuring transactions, both myself and we look to try to take advantage of those opportunities kind of along the way.
And Bart, I'd add there too on the stock appreciation rights. We get questions a lot on, well, can you discriminate within an ESOP? And that's the short answer there. Within the ESOP itself is no, but that stock appreciation rights or management incentive programs are designed to reward key employees. So an important feature of structuring these ESOP transactions to keep key management and get reward them for what they've been doing. Okay, company culture. Those of you that are familiar with ESOPs and employee ownership, I would say this is probably where the conversation starts right away in most instances, is culture and legacy. The selling shareholders, they want to reward the employees and the management team that have been alongside them throughout the process and really built the company up to where it is. That's usually where this conversation starts. Very powerful. It's another, the ESOP plan is another benefit for employees. So inevitably that's going to help recruiting and retention and a lot of the things that go along with that. We're seeing in the competitive labor market today, where that probably has an impact on if companies are going ESOP or not. There's just another recruiting and retention tool, and it's basically rewarding employees. Like Bart said, the employees don't have to put in any cash unless it's a KSOP. So as that builds up, another benefit. And the successful ESOPs that we work with, communication is very key, right? The culture of employee ownership. There's a lot of different committees at these companies that are set up, and they're really proud of what they've done, and so are the selling shareholders on the transition to their employees. Okay, business success and strategy. We've talked through some of this already. An ESOP is a lower stress ownership transfer method. If there is such thing as a lower stress ownership transfer method, but there is some differences, obviously, compared to a private equity sale or strategic sale. A lot of the core business isn't going to change in a sale or an ESOP transfer method. And the second bullet there, management changes only if shareholders choose to. And I would say typically management does not change. When a company is sold to an ESOP, the ESOP bought that management team that was in place, the profitable operations, and the last thing that they want to do is change what they just purchased.
I think one way to
go ahead.
Well, I was just going to say, one way to think about it, I think in terms of the ESOP, is it's a passive investor in terms of buying the company. And so the ESOP trustee negotiates on behalf of the ESOP, but they're not an expert in the particular business that they're buying. And so they're relying on that existing management team to continue the business on, and also to have a management transition strategy, so that not just, at the transaction date and the year after, that the company maintains profitability moving forward.
Yeah, shareholders can maintain certain amount of control. It doesn't have to be 100% sale to the ESOP. There's all sorts of partial ESOPs out there. It really can be, from 1% to 100%. It really just depends on, the desires of the shareholders. If they want to diversify some of their holdings. For a lot of shareholders, this is their, this is their life, their lifeblood and their biggest investment that they have. So we see some partial ESOPs that just want to kind of take some chips off the table, and it really is a case by case basis. On the 100% side of things, that does avoid and mitigate issues related to fractured ownership. If there is some small pieces of ownership out there that maybe doesn't make sense for the structure or the operations of the company, this is one way to basically get it all under one ownership umbrella. And shareholders can slow down, but they don't have to completely retire. We rarely see, I would say, selling shareholders sell and then walk away the next day. It's usually there's usually a process behind it, and it's done over a certain amount of time, and we'll get to some of the trustee discussion, but the trustee that's representing the ESOP doesn't necessarily like to see owners or shareholders walk away. So but they can certainly slow down, and with that next management team in place, can certainly slow down.
But we touched on a little bit earlier in terms of the unique tax advantages that I think are pretty well known with regard to ESOPs. And one we're going to start with is, the 100% S corporation ESOP structure, meaning that you have an existing S corporation or a company that elects to be an X corporation. It's owned 100% by an ESOP. In that situation, because the trust is tax exempt, and beginning in the early to mid 2000s, the IRS has allowed ESOPs to be a qualified subchapter S shareholder. You essentially create a tax-free company, meaning that it doesn't pay federal, and in most states doesn't pay any state income tax. And so when we talk about some of the debt that's taken on the transaction, you've essentially created a company that can grow on a tax deferred basis. When we get the question asked a lot is like, well, when does the government get its money? It gets its money when you actually have a participant that retires and receives a distribution of their ESOP account. At that point, it's taxed if it's not rolled over. And so similar to a 401k, once a participant receives a distribution, doesn't do a rollover, you pay ordinary income tax on that. But in the meantime, you essentially get to grow the company on a tax deferred basis or a tax-free basis. Thinking through that a little bit, in terms of what, ESOP companies, they don't necessarily just stay invested in their own stock. They may go out to acquire other companies. And if you're 100% S corporation, you leverage that tax shield, call it, so that you can make acquisitions of other companies and still take advantage of not paying any federal or state income taxes. So it can be a pretty powerful technique for an ESOP company if they want to go out into the market and start acquiring other companies. Another, probably important feature is the financing that's done in initial transactions to fund buyouts. That's also paid back on a pre-tax versus an after-tax basis. So it reduces some of the risk in terms of the cash flow that the company has to generate moving forward. Probably the last thing to mention in the unique tax advantages that we're seeing or maybe hearing about a little more is there is, with regard to C corporations only, there is the opportunity to do something called a 1042 rollover, which is very similar in concept to 1031s in the real estate context, provided you meet certain rules. And one of those rules is the ESOP has to own at least 30% of the company after the transaction. The owner selling the stock can actually defer tax on that sale, provided that within a certain time period, generally a year after the closing, they invest in qualified replacement property, which really is, if you condense it down as a summary, is operating stocks and bonds of operating U.S. companies. Provided that happens, there's actually tax deferral that can take place with regard to sales of an ESOP. sale to an ESOP.
Okay. Potential challenges. There's a lot of benefits to employee ownership in ESOPs. There is some challenges that come along with it. We've talked already about how ESOPs are a qualified retirement plan. With that comes regulation. No different than a 401k and a profit sharing plan. There's testing that needs to be done with all those plans. And they're governed by the Department of Labor. Department of Labor oversees is essentially all ESOP transactions, and ERISA oversees the benefit plans themselves. Administration costs. This is a question we get a lot. How much is this going to cost, the actual transaction itself? And they're not inexpensive. There's a lot of service providers that are involved. If you were to compare probably some of the costs with business succession compared to private equity or a strategic sale or an investment broker, these costs look pretty good compared to some of the 4 to 6% ranges on transaction fees. But clearly we're a little biased here, but when you need to look at all angles when you're looking at the cost side of things. The ongoing is probably a good thing to hit on here, on depending on how much you want to sell to the ESOP, right? Know that going forward, the ongoing costs are going to be probably 40,000 plus if there's an external trustee. So know that those costs will exist. Going forward, as it mentions there, it's the third-party administrator, the valuation. Every ESOP is required to have a valuation every year, trustee costs, and then reporting and compliance. So if companies are thinking about selling a small share to the actual ESOP, we usually have this discussion on does it make sense? Does the cost benefit make sense? Not only the implementation, but also the ongoing costs. The skewed financial statements, depending on what industry you're in, and the users of the financial statements, you want to be cognizant of what that transaction is going to do to those financial statements. Most if not all of these transactions, there's an element of debt brought on to finance the transaction. So you want to be careful on what that does to your balance sheet. And repurchase obligation requirements. As the participant accounts build up and shares continue to be allocated to those participants, there is a retirement benefit that has to be made whole at some point. So repurchase obligation is certainly something to be aware of through the process. Corporate governance and fiduciary responsibilities. We'll go into this a little bit more on one of our governance slides, but certainly something to be aware of. There is any individual or service provider involved with the transaction, there's fiduciary responsibilities and governance that comes along with that. The other one, last one there, financing, typically requires seller or company guarantees. Not necessarily all the time, but there is that element to some of these transactions, and it's rare to receive 100% cash at close. I think there's maybe some of these that we get into, they compare them to a strategic or a private equity, and they think, sellers think that they're going to get 100% cash out of close, and that's rarely the case. There's typically seller financing or seller carryback that's carried by the selling shareholder.
Yeah, maybe just one thing to add on the challenges, Kirk, in terms of the administrative costs, kind of goes back to that one-time opportunity to sell to a tax-exempt buyer. In terms of transaction costs, we can often, through contribution planning and tax planning, offset the majority, if not all, or more than all of the costs to implement the ESOP in terms of an initial transaction and ongoing. You do have the benefit if you're 100% S corporation ESOP where you're not paying taxes. So some of the administrative cost has a pretty good offset in some of the tax advantages that we see. A question we get asked, I think, in pretty much every conversation about an ESOP is like, okay, kind of explain the concept high level, but how does a participant or an employee that's part of an ESOP, how do they get stock in terms of their account, and how much do they get? And so when we talk about the participant accounts, generally how much a participant gets in terms of each year in their ESOP account is driven off of their compensation, meaning there'll be a block of stock that becomes available on an annual basis, and what percentage of that stock an individual employee receives is driven by what their compensation is relative to basically the eligible compensation of the whole company. So for example, if you're 2% of the W-2 compensation for a company for that particular year, you would get 2% of the stock that becomes available. Maybe one note on stock becoming available within the ESOP, until a share of stock is actually paid for, it doesn't get allocated into an employee account until, even if the ESOP owns 100%, if it hasn't paid back all the debt associated with the transaction at the ESOP level, until that happens, that share of stock is not allocated to a participant account. But as that debt is paid back, those shares become available on an annual basis. Within the ESOP itself, there'll be two accounts that are set up. One is the company stock account, which, like we talked about, kind of receives the shares that become available on an annual basis. And the other is basically a catch-all. Occasionally, you'll have an ESOP that, besides the company stock that it owns, will hold a certain amount of cash along the way. And if that cash isn't used to pay back that debt, if it's just held within the plan, you'll see, that two-part account balance for a particular participant. In most cases, unless it's a case-op or a unique structure, ESOPs generally only hold stock, and they'll hold a minimal amount of cash. So oftentimes that other investments account that's mentioned really doesn't have a significant balance in it. Again, just kind of jumping off of that a little bit, the reason compensation is often used is because it's a safe harbor in terms of discrimination testing, because the ESOP is a qualified retirement plan. And again, it's tax deferred growth. So even though a participant may have stock allocated to their account, they're not receiving, in an S corporation example, they're not receiving a K-1 for the amount of stock that's held inside their ESOP account. Again, it's tax deferred. It's not taxed until they receive basically a distribution of their account. Along the way, until there's what we'll call a triggering event, meaning that the participant dies, becomes disabled, or terminates employment with the company, that tax deferral continues on. And then at that point in time, the company is responsible for basically funding that retirement benefit. Like we talked about, we'll call that the repurchase obligation that the company has. So when that participant is left employment for whatever reason, the company is the one that has to come up with those funds to basically pay out that participant. So when we talk about the repurchase obligation, it is very important, and it's unique in that it's not a liability that shows up on an ESOP company's balance sheet, but it is something that's pretty vital for them to plan for moving forward, and it influences how we put initial transactions together. Mostly because the company is really the golden goose that generates the cash to fund this retirement benefit. If we're paying back acquisition debt, plus if we see significant repurchase liability that needs to fund, it can put a cash flow strain on the company. And for that reason, we'll often see, within the bounds that ERISA allows, deferrals of the repurchase liability, at least initially, while the company is paying back that acquisition debt in those early years. And then once that changes, moving forward, we'll often see that participant accounts are likely to be paid out, quicker.
Okay, well, here's a few of the common myths. I mean, and hopefully this presentation is just going to continue to educate the audience on what some of these myths are and what's real and what's not real. You know, probably the main one, I guess we'll just start at the top there. You know, sale to an ESOP can't achieve the same value as other transactions. You know, as we go through these transactions, there's a lot of different structure as we hit on already with some of the warrants that can increase value, some of the seller financing that can increase value, and really broadly speaking, there's a lot of different options to compete with some of the third party sales. You know, and another thing we talk through a lot with selling shareholders is, and Bart mentioned this, stock versus asset sale. You know, there's value, but after tax cash flow is at the end of the day what the selling shareholders are getting. So we go through that analysis almost on every transaction to make sure what that value actually is and what it means.
Yeah, I mean, the one we often, I think, get questions about are sales to private equity. And again, sales to private equity can make a lot of sense in the right situation. But in terms of, you know, a private equity transaction versus an ESOP transaction, an ESOP is going to be a financial buyer very similar to a private equity company. And so when we have companies that, you know, like in some cases, we'll actually do sort of a parallel track. They'll either go down the road of selling to private equity and then come back to the ESOP. They may not overlap exactly, but the ESOP is essentially in the ballpark in terms of, you know, the sale price. Again, obviously, how much cash down is different in an ESOP transaction. ESOPs are going to have significant seller financing, whereas private equity oftentimes does not. But in terms of the purchase price that's being paid, unless, you know, that private equity company has, you know, a portfolio of other companies that it's looking to add to, the ESOP can be competitive, you know, in terms of sale price for that. You know, maybe another common misconception is that if you become an ESOP, that all of the financial information and governance, you know, flows through, that all the employee owners, participants are entitled to that information. And that's not accurate. ERISA does not require ESOP companies to share all their financial statements, or really any of their financial statements, with ESOP participants, nor does it change the, you know, call it the management authority of individual employees. That structure essentially stays in place the same as it was prior to the transaction. In terms of what is required in terms of information to ESOP participants, they have to be given a summary plan description. They can always ask for a full copy of the plan document that's drafted as well. And they have to receive what's called a summary annual report with regard to their retirement account, along with an annual statement. But that's all that really ERISA requires in terms of required financial information to the participants. Certain companies will choose, you know, in order to try to enhance the employee owner mindset, will choose to share additional information, you know, after an ESOP transaction takes place, so that, you know, everybody at a certain level is aware of what the company, you know, company results and operations, but it's not required as part of an ESOP transaction.
Yeah, we kind of touched on this already with the ESOPs are only successful in certain industries. It goes back to employee dedication and management team. There is certain industries where it might not work, such as real high turnover industries, but you know, the ESOPs have a lot of different flexibility with regard to, you know, eligibility requirements and whatnot. So the next one, bank financing is available. That typically hasn't been the case from what we've seen. There's actually banks out there that just focus on ESOP transactions. So I think that's a myth out there that needs to be dispelled somewhat. There is certainly financing available for the ESOP transactions.
Yeah, and maybe, you know, one, talking about a loss of control on an ESOP transaction, and also, I guess, before maybe moving on to that, ESOP transaction costs too much. think we've already talked about that, while the cost is not insignificant, compared to other ownership transition strategies, it can actually cost less. And then you also have the added tax advantages on top. But besides that, the loss of control, and governance is a big one that we get asked about a lot. And again, in terms of the day-to-day management of the company, that has very little, if any, change pre-transaction versus post-transaction. And it kind of comes back to the concept that the ESOP is a passive investor. It's going to be represented, the interests of the ESOP are going to be represented by an ESOP trustee. Now, the role of that trustee in terms of fiduciary liability is they have to look out for the sole and best interests of the plan participants. And so in the initial transaction, the role of the trustee really is to negotiate the sale and the financial terms of the transaction on behalf of the trust. Moving forward, that changes a little bit after the transaction, and that the two things that the trustee really does, unless there's called a special transaction occurring, is that they have to approve that stock value that we talked about. Remember, the ESOPs have to be, the stock value has to be updated every year, and the trustee is responsible for basically setting that value. And the other thing that they'll do, the trustee, is elect the board of directors. The board of directors is really the key management or the key governance, body inside an ESOP company, in that, the board elects the upper management of the company, and the management's responsible for handling the day-to-day. As part of the negotiation of the sale, the trustee will often negotiate a certain number of independent directors to be added to the board. That's sometimes a majority, but sometimes not, depending on what percentage the trust is buying. But the ESOP trustee doesn't dictate who those independent directors are. They'll actually look to the company to find those independent directors, because they want to make sure that, again, because they're a passive investor, they want to make sure the board, the people that are on the board are contributing to the board, that they just aren't an insurance policy, that they're actually contributing to the growth of the company. And so they're very, in almost all cases, the trustee is very deferential in terms of who those independent directors are, as long as they're independent and understand, what their fiduciary duties are going to be. Like we talked about before, the management duties don't change as a result of an ESOP transaction. The same people who are the president, head of sales, go down the list in terms of the organizational structure. That doesn't change as a result of an ESOP transaction. So the company really, from a day-to-day operations point, doesn't change as a result of an ESOP. There may be a change in addition to, in terms of adding independent directors to the board, but that's really the biggest change. We also get asked a lot in reference to the trustee about whether it's good to have an internal trustee or an external trustee. And I would say, getting to talking about that initial transaction, I think it is, with the way the Department of Labor has examined these transactions, I think it would be very unique to have an internal trustee serve as the transactional trustee where the ESOP is buying stock. And again, that gets to the standard of care that the DOL puts on the trustees. Again, sole and best interest of the participants is the ERISA standard. And so it's very hard for an internal trustee who's working at the company. And let's say it's a CFO where they have to answer to the existing owner. There's almost sort of a view by the Department of Labor that it's very difficult for an internal trustee to really satisfy that high standard, because they're not fully independent. That's not to say that this is something that has changed, I would say, a lot in the last, call it 10 to 12 years in the ESOP space. We used to see internal trustees all the time. But the process and how the Department of Labor judges, trustees in these transactions has also changed significantly. Now, contrast the transaction, versus the ongoing operations, meaning updating the share price and also electing the board of directors. That is something I think that can be managed with an internal trustee. Again, it's not a different standard if you're an internal versus external trustee. It's that sole and best interest of the plan participant standard. but the opportunities for conflict are less on an ongoing basis. They can arise in certain situations, so it can be managed, internally moving forward. But I would say just overall, the trend has been to be, using external trustees that are either individuals or institutions that are experienced in the ESOP space that understand, how ESOPs are regulated.
Valuation considerations, clearly very important in any transactions, or in any transaction, as well as ESOP transactions. So we'll go over some of the different valuation methods here that basically, are used at the inception of the transaction and ongoing. The market approach there, as most of you are familiar with, is basically a public company approach. Similar companies, similar type sales that are used to analyze the transaction. Discounted future cash flows, I would say that's probably the most prevalent in ESOP transactions. The ESOP trustee wants to buy future cash flows of the company. So and we'll liken that to a multiple of EBITDA. The discounted future cash flows, multiples of EBITDA are used extensively in these ESOP transactions. And then the asset approach obviously is also tied into these transactions. And maybe I'll just start here too with Department of Labor basically has a standard of fair market value for these transactions. They won't allow the ESOP trustee or the participants to essentially overpay. So there's a fair market value standard with these transactions, and adhered to very closely with the service providers at the initial inception of the transaction, as well as the annual valuation going forward. The gifting versus sale. Obviously, there's different intentions. There's different intentions for gifting versus a sale to the ESOP. So the valuation methods there are quite different, and some of the levers and the discounts are very, very significantly in those types of transactions. We come across a lot of these different transactions that some selling shareholders think that if they're not going to sell a controlling interest, that they potentially should still get the same value for the company, and that's just not true. There's a potential discount if selling a minority block to that ESOP, because the trustee is gonna take control into consideration for that transaction. So there'll be some discounts related to that minority block.
I think maybe one thing to add there, Kirk, is the gift versus sale to an ESOP. We'll sometimes run into companies or owners that really want to call it a favorable price in selling to the ESOP, and there's nothing wrong with that type of a transaction. I mean, ERISA and the Department of Labor are concerned about overpayment. They're not so much concerned about an owner that wants to sell to the ESOP like on a price that's very favorable to the trust. So it's not that you're locked into it. It's just you can't exceed essentially the fair market value. You can always really come in underneath of it.
Okay, here's basically just the different types, the different types of leveraged ESOPs, and there isn't too much to get into in this slide. There's basically just three types, the employer loan, the indirect loan, and the direct loan. And the main takeaway from this slide is that the ESOP rarely has cash unless it's been pre-funded over the years. The ESOP itself before it purchases the stock of the shareholders. So there is a loan. There is a loan in most, if not all instances, unless it's a contributory ESOP or there's been some contributions over there. So and that internal loan essentially is what allocates the shares over to the participants. So The indirect loan, I would say, is probably the most prevalent that we've seen, where the company goes out and actually borrows bank debt to pay the selling shareholders off, and then the ESOP borrows from the company.
So let's talk a little bit about, what we generally see as steps in terms of implementing ESOP. And the first one's initial education, which this is what we're doing right now, right? What is an ESOP? People, do some initial due diligence to try to figure out what is an ESOP, how does it work? Is this a potential fit? And usually I think most companies that, are looking to the ESOP as an option, they do a fair amount of their own research online. There's a couple of organizations out there that I think do a really good job in terms of education about ESOPs. One of them being the NCO, where we got the statistics that we mentioned earlier. The other one is the ESOP Association, very good in terms of networking, with other ESOP companies. And so, we often see some called initial due diligence by companies that are looking at ESOPs, and then they generally reach out to a service provider that's experienced in the space to maybe take it to the next step. And I think from our perspective, the next step is something we'll call, a feasibility study or a transaction analysis. And kind of through that process, we look to identify, well, what are the goals specific to this company and this shareholder that we're looking to achieve by doing an ESOP, and can we meet those goals? An initial step a lot of times is coming up with an estimate of value of the company. It's not generally a full appraisal, but is the company of a value that makes sense to the selling shareholder at the time that they're ready to pursue a transaction. We've had a couple of transactions, that are in feasibility where, the company's not there yet for whatever reason. It's not meeting seller expectations. And so, the transaction doesn't move forward at that point. Maybe it's a couple of years down the road. But assuming that, there's sufficient value there that meets company and shareholder needs and goals, kind of take it to the next step, which is to put together, a more detailed, structure of the transaction, so that, what we're really looking to do is give the company and the owner a good summary. Okay, if you go forward with an ESOP, this is what this is going to look like to you as a seller, both as, on an after-tax proceeds basis. This is what it's going to, look like in terms of potential down payment, liquidity considerations. And also, what does this look like from the company side? Can you cash flow? If we structure the transaction a certain way, will the company be able to cash flow both any bank debt and the payments moving forward? And also, we want to see, a lot of times company wants to see, what does this look like from a participant point of view? What do those accounts look like? What kind of retirement benefit are we generating for our employees? And how does that change over time? All of that is really encompassed in, call it a full feasibility study or transaction analysis. Assuming all that looks good, and that, we go through that process and the answer is yes, we would like to do this. You kind of proceed to more of a phase two, and an execution stage, which is kind of fine tuning the transaction and strategy in terms of rolling this out. We talked a little bit about it before, but at this point in time, you look to engage an independent trustee. They will have their own team. By law, the ESOP trustee has to have an independent appraisal of the company, so they'll look to engage their own financial advisor. And they'll also look to engage their own legal counsel as well to represent the trustee in terms of the documents and negotiating the transaction. It's likely at this stage bank debt gets modeled, but you come back to the lending side, go back to the banks and basically present them with the finalized transaction structure if there's going to be bank debt that's going to take place. And essentially the transaction gets negotiated at that point. The company will offer, generally what we see is a term sheet that summarizes the material terms of the deal, covers probably 90% of the big picture issues. And then the trustee team looks at that, proposed term sheet and negotiates it both on price and governance and any other aspects that the trustee has identified through their, review and diligence of the company. And then, assuming that everything goes well, which it usually does, there's a closing and sort of final implementation. You finish up negotiations with a trustee. Final transaction documents are prepared for signature, kind of finalizing any due diligence. And once everything is complete, look to close and essentially fund the transaction at that point, in which case the ESOP takes title, to the ownership of the company.
Yeah, and we talked about costs and a lot of the service providers involved. And here's basically typical roles in an ESOP transaction. There's basically a buy side team and a sell side team. So some of the individuals that are involved there, the company has a financial advisor, has legal counsel, and then on the buy side, the ESOP trustee, they hire their own legal and financial advisor as well. It is a negotiated process, as Bart said. We talked about a lesser or a lower stress transition or ownership transfer, but there is negotiations that occur with this. I mean, typically there'll be term sheets sent across back and forth, and prices anywhere from price to insurance coverage is negotiated in these transactions. So here's the.
Well, I was just going to say, I think one of the trustees that's very active in our space, they refer to it as a friendly negotiation, but it's still a negotiation that takes place, along the way. And I think, when you look at these different roles, sometimes where you see, occasionally a Department of Labor where they've either brought suit to allege overpayment. All these roles are separate and distinct. They have their own purpose. And I think where that results from is, one of the requirements, besides not paying too much for fair market value, which is one part of the requirement that ERISA requires. The other part is the trustee has to negotiate the deal in good faith. And that's where these different roles come into play, is that if you start commingling, these different roles, it sometimes look like you didn't have that good faith negotiation. And so they're all, every role is separate and distinct and kind of has its own job in terms of the transaction.
Yeah, which, Bart, I would say is a lot different than 10 years ago or even 5
Absolutely.
years ago.
Yeah, a lot of this is what the Department of Labor has said, the process that they require essentially requires all these different roles in a transaction now.
Yeah, here's just a typical, if there is such a thing as a typical ESOP transaction timeline. We see anything from 3 months to 3 years. There's it kind of goes at the selling shareholders really their pace. But I would say a typical transaction timeline would be this 26 weeks. We'll call it 6 months. Probably 4 to 6 months is your average. And as Bart talked about, a lot of the feasibility, the value estimates, you can see that down that left side there, and just gives a little more clear picture on what all's involved and what the transaction entails over the course of its life. And then here's just one more. Okay.
I was just going to say maybe a good summary of some of those reasons to do an ESOP and not to do an ESOP. Kind of a little more expansive list of some of those myths that we've already touched on. I would say number 2, ESOPs are too complicated. They can be complicated. Whenever you're dealing with ERISA and the Internal Revenue Code, there's going to be some complexity. I think the key there is to hire good service providers that are experienced in the space to help you navigate through that process. The other one in terms of good reasons not to do an ESOP, if price is, very important, an ESOP is not going to be able to match the price, kind of like what we talked about before, of call it a key competitor or somebody who's willing to pay a premium for the company because of, an existing operation that they have. That's just, again, the ESOP isn't able to pay a premium for stock. It has to be based on an independent appraisal and a good faith negotiation.
Maybe just add to this too, Bart, we get a lot of questions on, well, how small is too small? And really it comes down to, value of the company and probably the number of employees, and that value number is probably anywhere from 3 to 5 million, and employee base is probably right around that 25 employees. It could potentially be too small or not cost effective enough to complete the transaction.
Yeah, no, I think that's exactly right. And, there's, I think one of the lists on there, if a company's not profitable, not generating cash flow, it's also likely not a good candidate for an ESOP. Again, the ESOP's a passive investor. And so it's really banking on is the fact that the company will continue to generate cash flow into the future. And if that's not the case, or for example, profitability is very volatile, sometimes those are not good candidates, for an ESOP as well.